In recent days, we've had speeches from two voting members of the Federal Reserve, Lyle Brannard, she's been a member of the Open Market Committee of the Federal Reserve for the last 2 years. She's a permanent member of the board. And Eric Rosengren, who is the president of the Boston Fed. I'm going to talk about what each of them was in their presentations. There is, on the website, there is a discussion by me on the Switzer program of Eric Rosengren. So most of the content that I'll be talking about today is in that video if you want to look at it or show it to clients. Then what I'll talk about is our model of the Fed funds rate, how it relates to the Fed's internal models and what it suggests about what the Fed might do when it meets a week from today's time. Lyle Brannard spoke to the Council of Foreign Relations in Chicago on Monday their time. Lyle Brannard is, when you read a resume, an enormously talented, brilliant person. Her job on the Fed is really the international economy and interactions with the international economy. There's always somebody in the summary of economic projections who has recently voted no increase in interest rates for the next 2 years. And I think I can have a high degree of certainty it's Lyle Brannard. There's a couple of reasons for that. Firstly, the international economy is much weaker than the US economy. Secondly, she has a view, and some international central banks have the view that the targeted level of inflation should not be 2%, but 4%. The Central Bank of South Africa, or the Reserve Bank of South Africa, targets 4% inflation. The Central Bank of India targets 4% inflation. So in her views, that interest rates should be kept low for unmoved for next year or two. I take that with the understanding that the downside for her is, okay, even if that's wrong, interest rates, all that will happen is inflation will blow out to 4%, and that won't be a bad thing. The problem, of course, for bond markets is that over the period in which that happened would be quite catastrophic. But it's a legitimate view, but I'm just pointing out that she comes from a different area with a different, with a non-consensus view of what the Fed might do. Eric Rosengren, on the other hand, is much more a middle-of-the-road guy. He's much more in line with the consensus of where the Fed is going. And what Eric Rosengren noted was that even though the US economy had been weaker in the first half of this year, it was much stronger in the second half. Now, he said that was because of a rundown in business inventories in the first half and a rebuilding of business inventories in the second half. He noted that incoming data to the Fed, such as the Atlanta Fed nowcast of data for the third quarter, suggests that the US economy in the third quarter is growing at 3.5% annualized. He also referred to New York Fed data as showing that it was growing not that high, but say about 2.8% annualized in the third quarter. So the third quarter was much, much stronger. But importantly, what he spoke about was the employment data and the interpretation of the employment data. And what's really interesting from looking at his presentation, and the next piece you'll see from me is a commentary on his presentation, is that it demonstrates that the way the Federal Reserve looks at the employment data is really very different from the way the market looks at the employment data. Now, I've talked about this before in terms of the difference between the Fed's emphasis on unemployment and the market's emphasis on employment. Now, Rosengren remarked that the US economy is at full employment. And he gave full employment, the range of full employment is between 5% and 4.7%. We are currently, he said, at 4.9%, and most estimates have us down to 4.7% in the near future. So repeating a line of country, which I've used pretty much for the last year or so, what he said was that if you don't have gradual increases in the Fed funds rate, what will happen is unemployment will fall very rapidly down to a level in which there are no more people to have jobs, and at that stage the Fed has to put up interest rates very rapidly, and that brings the expansion to an end. So if you want the expansion to continue for as long as possible, then you should be putting up interest rates now, and you should be continuing to gradually put up interest rates over the next year, because if you do that, well, that will stabilise employment at a long-term sustainable level. And in the discussion with Switzer, I remarked on the slide number 5, which is the slide which I will show in the piece that I write up, in which he contrasts what the Fed thinks is a sustainable level of employment and what the market thinks is a sustainable level of unemployment. Now, in the last month, we had 155,000 new jobs in the US economy, and the market thought that was too low. But what Rosengren pointed out is that the average of the last 3 months is 232,000 new jobs per month. And that's what he's looking at, is the average, 3-month moving average, not just 1 month's other. That's the first thing. Secondly, he said, if you want to sustain unemployment above this level of 4.7%, then the sustainable level growth rate of employment is much, much lower than the market thinks. It is between 80,000 new jobs a month and 100,000 new jobs a month, which is half or less of what employment growth has been in the last 3 months. So what the market thought as a weak number at 155,000 is in fact 1.5 times what the Fed thinks is sustainable in the long term. So you can see from that discussion that where the Fed is, where the Fed and the market are on completely different pages. Okay. Now, moving, what the Fed does, I've talked over the last year about the idea of natural rate of unemployment. The Fed also has a concept called the natural rate of interest, which is the level which in the long term, taking out the business cycle, stabilises inflation. In the short term, what they have as a model is a measure and a series of models of the neutral rate, which is the rate at which if you set inflation at that level, if you set interest at that neutral rate, it will stabilise inflation at the target rate that you want to achieve. Now, we run a version of their neutral rate model in the quarterly institutional presentation, and it is called the Fed inflation targeting model. Okay, so that's very, very similar to what the neutral rate is. Now, we know that's similar because the output of the model, when it comes out every quarter, is very, very similar to the median rate that comes out from the Fed in terms of their summary of economic projections. So last time, in the middle of the year, our model came out at 95 basis points, and the summary of economic projections was 90 basis points by the end of the year. Right now, our model is running at 107 basis points. The Fed funds rate is actually 40 basis points, and that means there's a 76% chance that the Fed will increase its rates when it meets next week. Now, that's not certain, but it's more likely than not. The market, on the other hand, believes that there's around about a 22% chance. So if you take the actual, what the Fed thinks, which is around about 70-some%, and what the market thinks, which is about 20-some%, there's about a 50% chance that the market is going to get belted after the Fed comes out next week. Now, that can happen either 2 ways. Either the Fed will tighten, and it will, after it tightens, it will announce a firming bias, or it may not tighten, but it will announce a firming bias. either of those will generate a different market expectation of Fed tightening than the market has now. That's the end of my comment.